Resolving bad loans or non-performing assets is back on the Reserve Bank's agenda.
This situation, in my opinion, should be a cause for concern to all of us. It is reminiscent of weak banks and stagnating growth witnessed by Japan in the 1990s, with repercussions even to date, and by Italy since 2010. Japan has experienced, and Italy is, in my opinion, experiencing a lost decade.
The Deputy Governor's scary picture, if we ignored the bad loan problem, is not an exaggeration. NPAs of banks has shot up to 9.5% in the December quarter from 9.1% in the previous quarter and 8.5% in the March quarter of 2016. Post the December quarter, Credit Suisse says 41% of the companies they track earned less than their interest outgo. Also, growth isn't helping. While earnings of corporate India rose by 9% in Q3, the stressed companies tracked by Credit Suisse reported 15,000 crore of losses. The economic survey also pointed out that neither growth nor the Reserve Bank's tools like strategic debt restructuring and S4A or stressed asset structuring schemes are helping. Everyone agrees bad loans is a tough nut to crack.
It is a very hard problem which should not be underestimated, because essentially, look, nowhere in the world is it easy to say, I will forgive the debts of the private sector.
The Chief Economic Advisor himself had proposed a bad bank last year. Now, the new Deputy Governor of the Reserve Bank argues that maybe two kinds of asset management companies are needed. One in the private sector to buy out easier loans, and one by the government to buy out accounts that won't recover for many years.
This private asset management company, this plan, the first plan, would be suitable for sectors where the stress is such that assets, the underlying assets to which banks have lent, are likely to have economic value in the short run with moderate levels of debt forgiveness. I conjecture based on anecdotal observations that sectors such as metals, EPC, telecom and textiles might qualify for this plan. Let me now turn to Model 2, which is the National Asset Management Company, or NAMC. This plan, the way I envision it, would be necessary for sectors where the problem is not just one of excess capacity, but possibly also of economically unviable assets in the short to medium term.
Well, that's the kind of proposals that we are getting from the Reserve Bank. Basically, the Reserve Bank Deputy Governor has proposed two kinds of asset reconstruction companies, one in the private sector, one in the public sector. The private sector ones for loans that require moderate forgiveness, and an asset management company in the government sector backed by government capital for loans that will not recover for many years, like, gas-based power projects and largely other power projects. Well, to discuss how we can take the NPA resolution forward, I am now being joined by the people who know where the shoe bites worst, the bankers. I have with me Rajneesh Kumar, Managing Director, State Bank of India, R.K. Bansal, Executive Director of IDBI, and Rasesh Shah, who heads Edelweiss Capital, and that company has a very successful ARC running. Gentlemen, thank you very much for joining me. Well, first let me come to you, Mr. Bansal. The first proposal which the Deputy Governor is putting on the table is that you pick up 50 large assets and give bankers a timeline. By 31st December, it should be done. You think that's a good way to start?
Yeah, I agree. It's a good way to start. But then if I really look at it, banks are already working on top 50 or 100 accounts overall. It's not as if bankers are not working. So maybe the additional thing I find is that you give a timeline that, okay, up to December you solve this. So that way it's a good way. But there are other issues which need to be sorted out, equity and capital, from where it will come. I'm not going to that, but I think it's a good way that way.
Okay, he also gives two other things, that the proposals put together by the bankers along with some private advisors should get a credit rating. Rasesh, is that a good plan? At the moment, of course, as Mr. Bansal says, there are some advanced plans for an SR, a Bhushan, for a whole host of accounts. Would credit rating be a good idea?
See, I think in concept it is a good idea, but you know, if you go back to why we need credit rating for bond markets and others, is when there are third-party investors who don't have the time or the capability to assess the underlying risk. In a situation like this, which is, you know, a few banks and maybe an ARC or whoever is the buyer of the bad debt, it's a very closed user group, and I would assume that they themselves will do a proper risk assessment. Like we in our ARC, if we are buying an asset, we would do a proper risk assessment, and if we need, we can rely on external credit rating or other advisors. But on the whole, if we are putting our own money at stake out there, then it is very important that we have the capability to assess and underwrite the risk. And I think that is why, since this is not a debt that will be listed in the market, that will be sold out there, so on the whole, I think the credit rating part may be useful but may not always be required. I think what is required, and also the earlier question that you asked, is there has to be a focus. But I would say that the bankers are already focused on that. And what happens in this is there is a lot of give and take involved between the bankers and the promoters, and everybody's trying to optimize. The bankers want the best deal, the promoters want the best deal, and in that, if you try to hurry it up, you might end up compromising the cards that you hold, because ultimately if the banks are in a hurry, then the promoters may end up extracting a much sweeter deal than what they should be entitled to.
One of the reasons why perhaps this deadline is being given is that very often, say, half the bankers agree, the other half don't agree, and the matter gets kicked forward so that the next chairman or the next MD has to handle it. That tendency is perhaps what the Deputy Governor is trying to check. But you know, there's another thing, Mr. Rajneesh Kumar, it is increasingly becoming clear that bankers are scared to give large haircuts, especially after the problem of the Kingfisher case, where the promoter is on the run and some bankers have even been arrested. Considering that, do you think this suggestion that some CVC forbearance be given is a good one? But my point is it absolutely necessary, and can it be managed by law?
Right. So managed by law, I'm not very sure that it can be managed by law. And whether any explicit guarantee come from any quarter that there is a complete impunity from the decision making. So that may also be very difficult, but definitely a process can be worked out, and as has been done also, oversight committee has been formed, where two independent former vigilance and chief vigilance commissioners are there, and they are people of repute and eminence. So that type of oversight committee that can definitely help. And bankers definitely would like that on the commercial judgment, because each case is so different, the haircut would also be different. So there cannot be a set rule in large accounts.
Yes.
It will differ from case to case basis, depending upon the situation, depending upon the cash flow estimation. So there cannot be a rule that if it is 50%, it is all right, and if it is 60% haircut, it is not all right. So that comfort in decision making for the public sector bank executives and whoever are the people or the boards, that is definitely required, and that has been what the bankers have been demanding, that as far as their commercial judgment is concerned, it should not be questioned unless there is a discernible quid pro quo or a mala fide. If criminal intent is there, then definitely go after them, but not on any other issue or any other.
Yeah, no, the point is the thin line between what you call criminal intent and what you call a business judgment. But you know, before I take my first break, Mr. Bansal, do you think that there is any new element needed either from what Dr. Acharya has suggested, or anything you think is needed as a banker to ensure that the first 50 cases are resolved before this year is out?
I think, as Rajneesh Kumarji was also saying, there are different schemes, but many cases we find they are not fitting into those schemes as of now. So maybe we have to do a normal restructuring. So in fact, as bankers, we have asked from RBI a few modifications in the restructuring schemes, if RBI agrees with that, to expedite this whole resolution process. The other issue finally is, I mean, some of the sector-specific issues also need to be seen, which is being worked out, whether it in steel or in EPC. So, because most of these 50 cases what we are referring to will fall into these two categories. The third category anyway DG has separated out, which is power.
Yes.
So, I think EPC segment is still improving and government is also trying to do something. But just before that, I just wanted to add one small thing. What I understand, the rating what they have referred, DG has referred, it's not a debt rating. What is virtually is the calling is it should be a business rating roughly.
Okay.
And that type of rating, as of now, I don't think rating agencies, I mean, it's like for equity also we have seen that rating has an issue. So I think the debt rating anyway will be below investment grade.
Okay. All right. Yeah, there would be that. I have to take a quick break, but I'm coming back and we want to discuss any other plans that our bankers may have, as also the National Asset Management Company plan, which Viral Acharya proposed to the Indian Banks Association. We're back in a minute.